Rat poison squared. Turds. Worthless artificial gold. These are the words Warren Buffett and Charlie Munger, two legendary investors at the head of Berkshire Hathaway, have used to describe Bitcoin. Men famous for their carefully chosen words. And yet, on this one subject, they drop the diplomacy entirely. What is it about Bitcoin that pushes two of the most measured investors to talk like this? In their eyes, Bitcoin fails one very simple test they've applied to every single asset they've bought for the last 60 years. Before we get to Bitcoin, there's one idea we need on the table, the one they use to separate real investments from everything else: productive assets. A farm grows wheat, an apartment building collects rent, a company earns profits. Lock any of them in a vault for 20 years, walk away, come back, and you're richer than when you left because they produced something while you were gone. If you want an overview of the idea, I made a video on it, link in the cards. For now, keep this in mind. Productive assets work for you. Everything else just waits for someone to pay more. That distinction is the entire reason Buffett and Munger talk about Bitcoin the way they do.
When you buy a farm, you look at the crop every year and what prices are, and you decide whether it was a satisfactory investment. I mean, you look to the asset itself and what it produces for you. When we buy a business, we look at what the business earns and decide how we feel about it in terms of what we paid. But we are buying something that at the end of the period, we not only have what we bought in the first place, but we have something that the asset produced. And when you buy non-productive assets, all you're counting on is whether the next person is going to pay you more because they're even more excited about another next person coming along. But the asset itself is creating nothing. Productive assets, you can pay too much for a productive asset. But I bought a farm in the 1980s, and every year look at how much it produced the way of soybeans and corn. And at the end of that period, I've still got the farm, and I've gotten some significant income off of it. Apartment house, operating business. But if you and I buy various cryptocurrencies, they're not going to multiply. They're not going to be a bunch of rabbits sitting there in front of us. They're just going to sit there. And I got to hope next time you get more excited after I bought it from you, and then maybe I'll get more excited and buy it from you. And actually, we could sit in the house by ourselves, and we could keep running up the price between the two of us. But at the end of the time, there's one Bitcoin sitting there, and now we got to find somebody else. And they come to an end.
A farm gives you rabbits because it multiplies on its own. It produces more than what you put in. A Bitcoin stays a Bitcoin. Come back in an hour, a year, even a decade. Still one Bitcoin. And that's where Buffett's grid gets really uncomfortable for Bitcoin holders. Because if the asset itself produces nothing, then the only way you make money is if someone else shows up later and pays you more than you paid. That someone else is what Buffett calls the greater fool. In finance, the greater fool theory describes any investment whose returns depend entirely on finding a buyer more optimistic than you were. The term itself was popularized by Burton Malkiel, a Princeton economist, in a book called A Random Walk Down Wall Street. The first edition came out in 1973, 36 years before Bitcoin even existed. And here's the irony of it. Malkiel and Buffett disagree on almost everything about how to pick stocks. But on this question, they land in exactly the same place. When you buy a stock, you have something to argue about. You can say, this company earns $10 a share and the market is asking me to pay $150 for it. That's 15 times its earnings. Fair? Expensive? Cheap? You can debate it. You have a number to push against. Now take away the earnings, the rent, the harvest, the dividends, everything the asset produces. What's left to argue about now? The price can go to 1,000, to 10,000, to 100,000, or it can collapse to 50. That's not a Bitcoin problem, it's a non-productive asset problem, and history has run this exact experiment before. Holland, 1637. For about 3 years, the price of tulip bulbs in Amsterdam had been climbing really sharply. At the peak, a single bulb of the most prized variety, the Semper Augustus, sold for the price of a canal house in the best neighborhood of the city. People sold their homes to buy bulbs. Skilled craftsmen gave up a year's wages for a flower they couldn't even plant yet. Tulips hadn't become useful. Nobody had discovered a new color, or a medicinal property, or a way to eat them. The bulbs were exactly what they had always been. People were buying them because they were absolutely certain that someone would pay even more for them next week. Until February of 1637, when a routine auction in the town of Haarlem found no buyers. Within days, prices collapsed by over 90%. Buffett's point isn't that Bitcoin is tulips, but any asset whose price depends entirely on the next buyer's enthusiasm lives in the same category. It's a category with no floor and no ceiling.
If the people in this room owned all of the farmland in the United States and you offered me a 1% interest in it, and you said for a 1% interest in all the farmland in the United States, pay our group, well, let's see, 10 million, pay us this bargain price, $25 billion. I'll write you a check this afternoon, $25 billion, now I own 1% of the farmland. If you tell me you own 1% of the apartment houses in the United States, and you offer me a 1% interest, so I'll have a 1% in all the apartment houses in the country, and you want whatever it may be for it, then call it another $25 billion or something. I'll write you a check. It's very simple. Now, if you told me you owned all of the Bitcoin in the world, and you offered it to me for $25, I wouldn't take it, because what would I do with it? I have to sell it back to you one way or another. I mean, maybe I have the same people, but it isn't going to do anything. The apartments are going to produce rental, and the farms are going to produce food. That explains the difference between productive assets and something that depends on the next guy paying you more than the last guy got. Now,
Long before Bitcoin existed, he was making exactly the same case against an asset most people think of as the ultimate store of value. Buffett ran a simple calculation. If you'd bought an ounce of gold at the time of Christ and held it for 2,000 years, your real return measured in actual purchasing power would have been about 0.1% per year. The reason, in his eyes, is the same reason he refuses to buy Bitcoin. So this whole conversation isn't about Bitcoin specifically. It's about a non-productive asset category that includes gold, cryptocurrencies, fine art, rare coins, anything whose value depends on the next buyer instead of on what the asset itself does. Buffett's grid has been the same for 60 years. Bitcoin just walked into a category that already existed. After all, when you ask Charlie Munger to describe Bitcoin in a single sentence, this is what you get.
Bitcoin is worthless artificial gold, which, if it succeeded, would facilitate a lot of illicit activity. Now, that is not something I think the world needs. And the fact that it's clever computer science doesn't mean that it should be widely used and that respectable people should encourage other people to speculate in it.
Seems that these two men have known each other for a long time. A few things to clear up before we close. Nobody in this video is predicting that Bitcoin goes to zero. Nobody is claiming you can't make money holding it. The argument is narrower than that and more precise. According to the way Buffett and Munger define the word investing, Bitcoin isn't an investment. It's a bet on what other people will do tomorrow, and those two things carry very different kinds of risk. That doesn't make Bitcoin worthless. It makes it something you have to think about with a different set of tools. The Buffett grid is one of those tools. Where Bitcoin sits inside it is your call to make. Thanks for watching. I'd really appreciate if you let me know you liked this video. Subscribe for a new video every week.